Welcome to the Build Better Blueprint, the podcast where we discuss the foundations of real estate, entrepreneurship, and personal growth. Join Christian Cardamone as he shares insights, strategies, and stories that will empower you to level up your business, your lifestyle, and your impact. Let's build a better blueprint for success, starting now.
Hey, this is Christian Cardamone, and you're listening to the Build Better Blueprint. Thanks for tuning in today. I've got a special guest, Randy Smith. He joins us today, and Randy brings over 25 years of experience in corporate sales and leadership to his role as the founder of Impact Equity. After a successful career in corporate America, Randy turned his focus to real estate investing, becoming a limited partner in 25 passive investments across 12 operators and 8 asset classes. Since launching Impact Equity in June 2022, Randy has helped over 115 investors place $9 million across 17 projects with 6 world-class operators. With a strong commitment to due diligence, transparency, and investor success, Randy empowers busy professionals to achieve financial freedom through passive real estate investments. In 2024, Randy launched Raise, capital coaching and consulting to help new capital raisers start their businesses and assist real estate groups in professionalizing their efforts to use modern tools and automation. Randy's also the co-host of the Gentle Art of Crushing It podcast, where he shares insights and strategies to simplify and demystify real estate investing. Randy, welcome to the show.
Thank you so much for having me. Glad to be here.
Yes, awesome. I haven't read that much since college, so
That was a long intro. You're right. Yeah.
My brain is smoking, but that's very, very impressive, man. So I can't thank you again for your time today. I know it's around the holidays, so we're grateful to have you. And I had the opportunity to meet you and do your podcast a while ago, The Gentle Art of Crushing It, which I've been devouring episodes. Man, it's great. A lot of content and
Awesome.
A lot of really sharp people on there. So hats off to you as a successful podcaster.
Yeah. Thank you. It is, it's kind of a thankless job at first, but over time it gets some momentum and yeah, it's been a lot of fun. Got to meet a lot of really neat folks, yourself included. So yeah.
Awesome. Well, keep up the good work. So let's jump off a little bit, learning about you and kind of where you came from and your journey from corporate America, seems like, into real estate and how you became part of the best industry in the world.
I love it. I love it. So yeah, I'm just a sales guy. I went to college in Northern Michigan, little small town up there. My parents were entrepreneurs and owned a restaurant. So I was kind of in the trenches working from a very young age, probably too young age. If there's any like employer, legal companies listening out there or what have you. But yeah, like literally 9 years old, I was working in the parents' restaurant and just kind of built my work ethic there and kind of brought that into a sales career. And I spent 25 years in corporate America sales, primarily in very large Fortune 100, Fortune 200 organizations. 20 years of that 25 was with 2 different companies, 2 10-year stints. So I got used to that corporate life. I worked for big, respectable brands, so that was always a benefit. I was always proud of the companies that I worked for, but working for somebody else has its disadvantages as well. You kind of lose control. And my situation was one where I got laid off from each of those organizations after 10 years. And I was a top producer. I was an award winner. I was President's Club winner. So really when it came down time for me to get laid off from both of those, I really was just another name on an Excel sheet. And it didn't matter how good I was, how all the accomplishments I had, or the leadership impact I was having. I just happened to be one of the 140 people that got laid off the last time. So the lesson for me early on was when I got laid off the first time, I was pretty much I was making very good money, but I was living paycheck to paycheck. I was spending every dollar I was making. So when I got laid off, it was a really scary time and I didn't know what I was going to do. Like I was watching the clock, waiting for the severance to wear off. Thank God I had the severance, but just fortunately, before the severance wore off, I ended up landing another great job and it was great. But about 5 years into that, I started thinking back to that layoff before, and that's when real estate kind of came into my picture. My dad had done very well in real estate, so I knew that I was always going to do it someday. I thought that I had to reach some level before I could do that. I know today that you don't have to do that, but I started building my own real estate portfolio about 5 years before I got laid off the second time. And as luck would have it, that portfolio created some security and provided me with some options and essentially catapulted me into this new career that I have after I got laid off the last time. Without the real estate that I had started investing in 5 years earlier, I would have just had to go back and find another W-2 job.
Jeez, man. Yeah, it's awesome though that you had kind of the foresight to see, having gone through one transition, coming to that realization where, after all of your accomplishments, then at the end of the day, when the guillotine comes down just to trim fat around for whatever reason, clearly it wasn't performance, then just to be pushed on the wayside. So I'm glad at least you had, like, again, the foresight to see that this is coming down the road at some point. Even if it wasn't on the horizon, it always is looming because you're not in control of your own destiny when you work for someone else.
It always is. And if you're in corporate America, layoffs come every couple of years or so. It's always the same thing. Like, everybody starts talking like who's going to get it this time and what's going to happen. But yeah, every couple of years, if you're in a large enough organization, it's a matter of time before you happen to be the guy that's on the row on that Excel sheet that gets let go that day.
Well, so you leave your W-2 and you have started building a portfolio along the way. And at what point in time did you realize, wow, this is actually performing? I have some stability, some peace of mind, which I know that's a great feeling to have when you know you have active income and you also have kind of some retirement future to hold there as well. And then what kept you from just investing in more of those single assets or whatever? What was the transition like to say, I want to get into something bigger, kind of pull back the curtain and look into the next level?
Yeah. So when I first started investing in real estate, I was buying single family homes out of state. I live in Phoenix, which was a big appreciation market. So, the 1% rule doesn't work here. You can't cash flow in anything. It's primarily an appreciation play. So I ended up buying houses in Kansas City, in Atlanta, and we had 7 houses, I think, at one point. And it became very, very clear to me that the time, energy, effort, work, reward that I was getting out of buying single families was not something I was going to be able to scale to the size that I would need it to. Like, the simple math was I either needed to own 50 single family homes completely paid off or 100 that were financed to create the type of cash flow that I wanted to create for ourselves. So I immediately started looking at multifamily investing and found out very, very quickly that I did not have the skills or the expertise or the knowledge or know-how to jump into that space. And it's one thing to buy 100 in Atlanta and another thing to buy, a 5 or an 8 or $10 million apartment complex. It's a lot scarier to bring those type of dollars to deals. So I decided to just start passively investing with very large, skilled operators that had good track records because, quite frankly, they're better at it than I could possibly ever believe to be. And I thought there was much less risk by going down that path. So I jumped all in. I shifted all of my dollars from single families over to passive investments in primarily multifamily. And when I got laid off, a large portion of my monthly expenses were covered by passive income at that point.
It's amazing. So it works. So we see it right there. Tell me about when you decide to dispose of all your single family and then you have this pile of money there, how did you go about selecting these funds? And was it one fund, a handful of funds? What was your process like for someone who maybe is sitting on money and they say, we'll talk in a moment about the services that you kind of provide. But if someone was saying, I've got a couple $100,000 here, how do I deploy it? I don't know the first thing about it.
Yeah, I think there's a learning curve, just like there is with anything. These are important dollars. So it's important not just to throw money around carelessly, with any operators. So that due diligence process that you need to get comfortable with needs to evolve, and it needs to be backed by some type of expertise or science or something behind it. Now, I will share with you early on, I probably deployed capital too quickly. Because I was deploying back in, 20, 21, 22, when we were, high up and to the right. And some of those assets have come back down now. So some of those early investments are not likely going to perform as I had hoped that they would. So I think it's important to have a due diligence process, have a heavy diversification process in place, and be I think it's important not only to diversify across asset classes and business models and geographies and operators. I think it's also important to diversify over time in the market as well. So if you've got a couple $100,000, my advice would be don't put $200,000 into the market all at once. Kind of stagger that over 6 months, 12 months, couple of years. So you're also staggering those dollars throughout different time periods in the cycle.
Awesome. Yeah. So then I guess that's a great point, because then as some of them do come full cycle, or they mature out, or if it's a new construction, perhaps if it gets completed and then financed out of, they're not all maturing at once, or you're not going to get a boatload of cash back, and then you've got another set of problems to have.
Exactly. Yeah. I don't want to be in a position where I have to deploy capital, like a very large portion of my capital in any one time within the market. So, kind of the strategy I share with folks is like decide as a household how much exposure you want to this space, and then look at deploying that over the next 2 to 5 years and do it equally over a bunch of different deals. And, it's counterintuitive essentially I'm a capital raiser. So somebody comes to me and they've got a big check. Quite often I'm telling them, like, I probably don't want to take the entire check right now. I'm going to have 6 more deals in the next 12 months. Let's spread it out at minimum over a few of those deals. And maybe let's consider even spreading it out over a longer period than that.
Yeah, well, it's good to hear. It's kind of refreshing to hear that, because that speaks to probably, I don't know if you are regulated by a licensing board or anything, but it seems like you have that kind of fiduciary mindset or capacity with your investors, because some folks that are in the capital game, which, give me the money, and then now I've got it on my side of the fence. I'll deploy it, I'll take care of it, but it's always best to keep it as long as you can, I think, until you know exactly where it's going and under whose kind of tutelage. So one thing that I have a question for you is, someone who is investing in a syndication, how important is it to have the discussion about, is this going to be, are you looking for an income source, or are you looking for active income? Or I think a lot of people forget that real estate investment is over a period of time. So these aren't things, some people, I think, they get stars in their eyes and they want to invest, and then they plan on getting rich quick and just having monthly, fat checks come in. In reality, it's a long-term game. So that's probably a big part of the discussion, I would imagine, right?
And it needs to be. Yes. I don't think that it always is. I think people get, as you mentioned, kind of starry-eyed. They get excited about a deal, but it's really, really important at first to decide, like, are you a cash flow investor or are you an equity investor? And, when I first got into this space, I was very much an equity investor. I had great W-2 income. I didn't even really want any additional income because I was already in the 37% tax bracket. I didn't want to pay more taxes. So my goal was grow that bucket in tax preferred way as much as possible, but I don't want any cash flow. Now, when I got laid off, I immediately became a cash flow investor, and I had, almost 7 figures tied up in equity deals that were not kicking out hardly any cash flow. So it's important to look at those things and adjust your portfolio in a way where if you need to make some adjustments, you have the ability to do that.
And so if someone were to do that, a lot of times in a syndication, the money is locked up for a period of time. So if someone wanted to do that, do you just help reallocate or redeploy additional income that you're bringing to the table? Or do you have the ability to move money between syndication? I mean, most of the time they're private operators, so I'm curious how you could do that.
Yeah. So, I mean, if you're in the value add space or if you're in a long-term hold, those are illiquid investments. You don't have the option of saying, hey, I need to change my strategy. Let me get the money back and put it over there. So I think it comes down to deploying the capital in over a large number of times. So you have dollars that are coming out like that. But certainly as you adjust and your needs change, then new investments would fall in line with whatever strategy you're searching for. So
that's great. I can see now kind of tying that around to your initial point of deploying money over a period of time, because then you can see they will kind of redeliver on a schedule if you did need access to money. And if you don't, you send it right back out. But if you do need it, that's the opportunity, kind of like a fruit that's bearing, or a tree that's bearing fruit every season, something like that.
Exactly.
So.
Yeah. Because if you think about it, like if you put 50 grand or 100 grand in a deal every year for 5 years, now you've got every year something should be cycling. And then you get to choose what you're doing with those dollars at that point. So
yeah, that's great. I heard, there's the old like real estate investment strategy where people say, buy a house, a single family house every year for the next 10 years, and then just sell one every year for the next 10 years. And so you've got 20 years worth of investing, and every year you've got like delivery of these funds. And it's essentially doing something like that on a similar basis, just with the syndication. It just takes all the all the stress out of it, you're not putting on a roof halfway through a cycle or anything like that. You're just
Yeah.
keeping in touch.
Yeah. Well, the operators are, but you're not, right?
Exactly.
Absolutely. Yeah.
Yeah.
Yep.
So, okay. So question for you. So this is kind of like a blueprint model show. Let's, because it looks like there's two different folks that may be listening to this. One might be someone who says, I want to invest in syndications. And then someone might say, I want to start a syndication. And so I'm curious, because we can talk more about your services that you provide with Impact on helping someone invest in a syndication.
Sure.
But if you want to start a syndication, what does that look like? What is because correct me if I'm wrong, the genesis kind of an investor's path generally is I start buying assets of some nature, and then eventually you run out of money. And so then you say, well, I still want to invest, so I need more money. So now I'm going to start to attract partners with me who see that I'm being successful, and then I can take their money. We can go buy bigger things, but now I'm kind of managing the asset and I have to give everyone their dividends or distributions or whatever along the way. So what does that process look like for someone who wants to follow that path?
Yeah. So I think that generally you outlined it exactly. It's like somebody usually gets starts in the space, they start doing their own deals, and then at some point they run out of cash. What I think makes more sense is to do partnerships at first. And partnerships could just be you as an operator who have a network of people that have access to capital, but they don't have your expertise or time. And then you just partner with one or two or three or four of those people to do projects. Very, very small, not necessarily regulated by the SEC. You don't need expensive attorneys. You can literally go out to ChatGPT and set up operating agreements to do joint ventures or those types of projects. Now, at some point, you're going to probably get bigger and need to bring more people into those deals than just, let's call it 4 people. I kind of look at, 5 and under, you're probably okay just doing very simple org structures. But once you get over 10, you definitely need to start looking at some type of a syndication that has, some type of either a 506B or 506C, an SEC exemption, essentially. So at that point, you need to invest with the attorney and then start to scale that business that way. The benefit is that you can now start sharing these opportunities with everybody that's in your direct network. So anybody that you've got, air quotes, a pre-existing and substantive relationship with, meaning you've known them for some time. Like they know you, you know them, you're comfortable with each other, you've got a good understanding of their financial capacity and their sophistication, then you can bring all of those people into it.
Now, those folks need to be accredited, do you know, or is that something to discuss there?
Initially, if you're using a 506B, they don't have to be sophisticated. Okay. Now, the difference between a B and a C is that the B, you can have up to 35 non-accredited investors and as many accredited investors as you want. And the cool thing is that the accredited investors you don't have to verify that they're accredited. It's just a self-certification process. So they say, I'm accredited, you move on, right? Now, inevitably, what will happen is people can grow generally very large just doing B opportunities. And in fact, like 85% of all syndications, and it might be 82, it could be 88, something like that. But the very vast majority of syndications are all B opportunities. So most deals getting done today are those type of friends and family type of deals. But at some point, you're going to exhaust your friends and family as well. And that's when you can go up to 506C, or there's all kinds of other options. But then you're only dealing with a minimum of accredited investors at that point.
Okay. And for folks listening, an accredited investor is someone who makes $250,000 a year or more. Is that correct?
So it's one of 3 different things need to apply. One is you have a net worth of $1 million, excluding your primary residence equity. Or 2, as a single individual, non-married, you make $200,000 a year. Or as a married couple, you make $300,000 a year. So net worth or income requirement, and the income is broken between either single or married.
Okay, awesome. That clarifies that. And so really the difference between the 506B and the 506C is just your ability to who you can solicit to. Is it correct?
Right.
Okay.
Yep.
Awesome.
Well, and actually one other thing, like the 506Bs, you cannot publicly advertise because you can't only the only way you could privately advertise is via email, text, phone calls, those types of things. But once you go into the 506C arena, you can literally use paid ad. You could get banners if you want, TV, commercials, radio, whatever you want to do. Like you can broadcast from the mountaintop to anybody that's listening that is
Yeah.
accredited.
Interesting. I wonder, do you know how like social media works on that? Because a lot of folks, if they're posting on their own private social media page about a deal they have, is that a little gray area, or how does that work?
Nope. That would have to be a 506C opportunity if they are advertising on social media.
Okay, gotcha.
Yeah.
That's good to know.
You can't say, well, we're connected on LinkedIn, we know each other, so then I can advertise. No, you need to have a substantive relationship. And it's interesting, like the SEC doesn't define that real clearly. And if you line up 10 different SEC attorneys, you'll get 10 different answers on it. So like what I've done is that I have a requirement where we've had a conversation either on the phone or in person. They've received some educational material from me. Maybe they've listened to my podcast. We've had multiple interactions via email, and at least 30 days have passed since we first met. Now, there are likely some SEC attorneys that would say or argue that that doesn't satisfy it, but my SEC attorney has reviewed that policy and he agrees with me, so we're okay.
Yeah. So you're good, and that seems very reasonable. I mean, at that point, you've built somewhat of a relationship with somebody because again, this is a two-way street, right? So you've got to go. You're going into business with these folks. So really, even if someone were to come running at you with a bag of cash, it's incumbent on you to do a little bit of due diligence on them as well, because you're going to be getting into business with them.
And absolutely. So they also have to be what is considered a sophisticated investor, which is also not clearly defined by the NCC. So have your policy and your procedure in place for determining that as well. And what I've learned in the last handful of years is that early on operators will generally take money from anybody and everybody. And over time, you learn pretty quickly. There are some people that these type of investments are just not cut out for. If you've got, like the analogy I always use, like single mom with 2 kids at home that's waiting for, their tax return to come in so they can get their $7,000 or $8,000. If a K-1 gets delayed for 6 months, like that's going to put severe financial distress on that household. And while I think everybody should have access to these type of deals, I don't want to put those types of people in these types of investment because it can ultimately hurt them terribly. God forbid we lose the capital. If that's going to put them in harm's way, we don't want those type of people investing in these type of deals.
Yeah, that's great. And that kind of is that level of sophistication. You could use that as defining, like, are you sophisticated enough just as far as managing money, just to know what's disposable, what's not, what's the dedicated as investment funds, and then this is like our livelihood, this is our rent money. So definitely important. Tell me a little bit now about impact equity then. So if someone wants to get into the investment game with you guys, tell us about the services you provide and how they can get in touch with you for something like that.
Yeah, so we're basically a due diligence company. So our goal is to provide well-vetted opportunities that have diversification to our investors. So we diversify across operators, across geographies. We diversify across business operations, like business models. And goodness, I'm blanking on the other one, but we've got like a 7-stage diversification process. So we have a due diligence and vetting process where we go through over 100 different items that we double check to make sure that they check all the boxes to satisfy our due diligence. And then, of course, our investors are expected to do their own due diligence as well. So really, our people are gaining benefit from us because we've got a really intensive due diligence process. I personally am investing in a lot of these deals, not all of these deals, just simply due to cash flow. But ultimately, I'm creating offerings for my own personal investment needs that I just share with my investors as well.
That's awesome. It sounds very much like if I was to be in syndication, I think that seems like a path I would take because you kind of want to bring folks along on the ride with you.
That's it.
And if you really just are continuing to play your game, but you're just inviting some folks on your bus, and you have your kind of investment strategy as the North Star.
Yep, exactly. So that, and my goal is to have 5 or 6 different operators I work with probably 2 or 3 different asset classes that I'm keeping all of my capital in, and then we just make those available to our investors as well. So
Okay. So, and
yeah.
tell me what you think right now the top 3 asset classes are that you are watching, and are there some that are like Old Faithful, like bonds, like if you were in the stock market, something that would translate to here's a safe play, then here's something a little more moderate, and then here's something a little bit more aggressive?
Yeah, so I'm a multifamily guy. I think there is such a need for affordable housing in the United States, and the runway is 10 plus years long. So I am 80% multifamily. But with everything that I do, I like Class B value add multifamily. So not heavy value add, but paint and lipstick value add. I like things that are, call it late 80s or newer vintages, and I like Sunbelt states. So that's primarily where I invest my own dollars and where I make those type of deals available to my investors as well. Now, in conjunction with that, or in alignment with that, I like mobile home as well. I've invested probably 10% of my capital I have in mobile home communities, and I'll likely introduce mobile home to my investors this year as well. But really, those are the main 2. So
Okay. Awesome. And then, so question for you with the mobile home, that's something that I just love. Do you guys specifically seek out, parks or communities where it's mainly just like lot rent, or do you guys do the home and the lot and then sell off the homes, or do you have like a model behind that? And how involved are you after the acquisition in kind of I guess the trajectory of the value add beyond that?
Yeah, so I've not landed on an operator that I chose to partner with here. I like operators where they have an infill strategy as well. So either one, they're putting new assets on there and then selling those assets. I don't want to be a landlord in the mobile home community space. I think it makes more sense to sell the assets, potentially even on like a lease to own. Like I see a lot of operators that are doing a lease to own option. But yeah, I think like the benefit of mobile home is that it's generally lower operations requirement because you're essentially just renting land. You're not renting the units themselves. And then if there's turnover, you're just finding a new tenant to buy that new asset. So if we do choose to go into that space this year, probably not going to want to be working with operators that have a lot of operator owned assets or units in their parks.
Gotcha. Good. It's wise. Yeah, I heard a gentleman once say, who was a landlord, or he owned a mobile home park. He said, "Can't hurt my dirt." So,
Yeah, exactly.
buy it and just collect the rent on it, and you can beat it up all you want, but you can't hurt my dirt. So,
Yeah.
I love
And
that.
also, I mean, this kind of a side note, I do like self-storage as well. And I like industrial. I like a lot of them. I just can't know 10 different asset classes well. So I'm trying to choose my lane, and it's multifamily, multi-tenant, all on one plot of land, kind of going back to where I started, at least initially. So
That's awesome. So I have a question for you, because I've heard, a lot of the headlines are that multifamily is we're getting overbuilt with all these luxury apartments. I don't know about your market specifically, but if you're seeking investments nationwide, it's probably not directly applicable. But in our small market here in Wilmington, North Carolina, a lot of folks are up in arms because we have all this luxury inventory coming, and they're saying, is there too much of it? Who's coming here? Who's going to be renting all these? Who's making all this money? But one thing that I had kind of learned through my education in that process was that we need delivery of these new Class A, because that then creates Class B, which then pushes and creates Class C as it goes down, because as these things age, we need the next generation coming. So that's kind of the life cycle of these big complexes.
Sure.
So I thought that was very interesting.
Well, and I mean, yeah. So the reality is if there is a demand or a market and there's cheap enough capital available, development's going to happen. Okay. And the opposite of that is true, is if there is not cheap capital available, then new development is not going to occur, at least not going to occur at the level that we saw historically. So yes, we have seen building and development trends over the last, since the beginning of debt, that when rates are lower, we have heavy development, and as they go higher, it starts to decrease. We're just coming off of a situation where deliveries have been just through the roof over the last 2 years. And we'll start to see those start to come down a little bit as we go into 2025 and towards the end of 25. It actually is the lowest amount of deliveries that we've seen in, I don't know exact terms, but 20 plus years. So that actually creates an opportunity for multifamily where decreased deliveries will create supply constraints, which will give us the opportunity to increase rents again. And, the cycle goes on. So the last couple of years have been hard at multifamily, no doubt, because we have some of that huge upswing in, 2021, 22. We're coming out of the back of that now. And I think the next 5 to 7 years look really, really strong for multifamily.
That's awesome. Do you see a lot of folks who have this, I don't know if it's a false sense of opportunity or if it actually is bona fide, where, this shadow inventory of all these notes that were 5 to 7 year notes that were set to mature or expire here in the next 12 to 24 months. Are you seeing any of that where there's capital calls or folks are having to return assets to banks or investors swooping in and buying them for pennies on the dollar? Or is that more of like a media spectacle?
Yeah, I think everybody's been talking for the last 2 years that there was just going to be blood in the streets and, now would be the time to swoop in and grab up all of this. The reality is the banks have not started taking assets back anywhere near at the level that we thought that they might. You've heard the term of extend and pretend. So the banks are, if the operators are paying their notes, then the banks are working with them because there is such a huge amount of debt that's coming due that the banks can't possibly take it all back. They don't want to be operators. They don't want to run apartments. They're debt people. That's it. Now, if they stop paying the mortgage and stop paying the notes, at some point, the bank's going to have to make hard decisions. And what I'm seeing is that the banks are going to very good operators and they are trying to partner with very good operators to take over those assets. But still, at some point, those banks are going to have to write off this debt to get new operators in place because a lot of these deals, they don't pencil just at the loan amount. So that doesn't even talk about all the LP equity that's at risk. If you got rid of all of the LP equity, there's a lot of deals that just simply don't pencil just based on the loan value alone. I don't know. I don't think we're going to see rates drop enough. A lot of people are saying that we could potentially see rates go up over the next year, but I think distressed operators will be the opportunity to go in there. And some operators are going to lose investor capital, no doubt.
Yeah, it's sad. I guess that's just part of just the process, and that's just the world we live in that arena. Because folks who got in when the tide was coming up and everybody was doing good, a lot of folks haven't had a chance to go through the experience of an actual cycle, economic rate, everything. So we'll see what folks are made of here over the next couple of years because where the rubber meets the road, So, but there will be folks who are watching this. There's a lot of capital on the side that's ready to hop in and participate. So I think it's going to be an interesting couple of years regardless, but the players are still going to be investing the whole time.
Yep, absolutely. And I would argue that passive investors, I take an approach of dollar cost averaging. I'm going to invest throughout the cycles, and there are always good deals that are going on in the market, regardless of what's going on. So if you set as a passive investor a goal to deploy $50,000, $100,000, $200,000 a year, and you just go out and search for the best deals that are out there, they are out there to be found. But you've got to improve upon your due diligence process to find them because there's a bunch of garbage out there too.
Yeah.
So,
yeah, 100%.
Yeah.
Okay, so let's pivot a little bit, and I want to see if you could tell the audience about your philosophy on the importance of hiring a coach or joining a community. You and I are both members of GoBundance, which has just been an awesome experience for me so far, even though it's relatively new. I've gotten a lot out of it and been able to meet a lot of awesome folks like yourself. So tell us about your philosophy on coaching. I know you have a coaching and consulting, so tell us about that and then your thoughts.
Yeah. So I think the easiest way to do anything is to find somebody that's done it before you and follow their path. You can always adjust and make slight changes in the process. But if you know that doing X, Y, and Z works to get you to this ending, why would you not do that? Right? So find somebody that's done what you want to do and get as close to them as you can, whether you got to pay them or just get into a community, or if you need to do some special activities and get in front of them to get some favor and get some guidance from them. So hands down, best thing to do. fortunately, going all the way back to my corporate years, like I was always in a position where I got assigned a mentor, and I was a mentor to other people as well. So that was the general process was go into a new role, get very, very good at it, and then teach other people how to do that. And I've kind of taken that same strategy as I left the W-2, and I got very good at passive investing. So now I teach passive investors how to passive invest. By doing that, I had some really good results raising capital. And once again, I've gotten good at that. So now I'm teaching other people how to do that. And yeah, it's just kind of a natural progression. I think at my core, I'm a teacher. I like to be able to teach people how to do things. I think you find a lot of people in different spaces where they've got this scarcity mindset where they're afraid to share best practices because they think somehow that's going to impact their ability to perform. But I'm of the opposite mindset. Like I'm an open book on everything I do. I'll give it away because there is so much opportunity that like literally like between you and I will never be in competition at all. Like you've got a completely different sphere of people that are around you than I do. And like, there's no reason to split hairs over that. So yeah, I'm a big believer in mindset coaching. I'm a big believer in skills or tactics coaching. And I think the mastermind community, as Jim Rohn has always said, you're the sum of the 5 people you hang around with the most. If you happen to be surrounded with 1,000 amazing, high charging entrepreneurs, like it's amazing the type of results that you can see from that. So
yeah, that's great. It's so true too. It's the rooms that you're in, you always want to be not necessarily the dumbest guy in the room, but you always,
Sure.
you don't want to be the smartest guy in the room. If you are, you're in the wrong room.
Exactly.
You're never going to expand beyond that if you're your own, your own bottleneck. So being surrounded by folks that are doing bigger things and things that you never even knew existed, that's the most exciting part about it. And you're right. There's enough for everybody. There's so much money out there. It's just, you just got to go out and get your share. There's more than enough for everybody. And so in supporting each other, I think you'll go a lot further, a lot faster. So
I agree.
that's great. So why don't you let me know a couple of books or podcasts that you have been listening to right now that you think that our audience should consider taking a look at?
Yeah, so it's hard to pick. Like I always set a book goal every year, and I think I read 18 books this last year. I fell short of my 24 that I was shooting for. But a book that I read just recently for the men listeners, there's a book called Masculine in Relationships that was suggested by a bunch of people in GoBundance. And I remember when I heard the title, I thought, oh, toxic masculinity. Not sure if I'm going to like that, but it really gets into like the man's role in the relationship and allowing the spouse to be in their role as well, which was a game changer for me. My wife and I both really loved this book, so I'd highly suggest that one. There's a book that really challenged my views around generating wealth and then handing wealth down to the kids called Die with Zero, which was just an amazing book that really, really challenged my belief systems around wealth accumulation. That I think is really good. And then on a podcast, I love the All In podcast. It's a must listen. I'm liking Alex Hermosi and I love Ed Milet, so I listen to both of those.
Yeah.
And there's a good one that I'm listening to that's talking about the markets called Thoughtful Money with Adam Taggart. It's a daily podcast talking about all things economics and stock market, which is really neat because he brings on he's probably got 30 different experts that he brings on at regular intervals, and they're not the same. They don't all have the same viewpoint. So it's neat to hear different people's opinions about what's going on in the markets.
That's excellent. Thank you for that list. That's a great reading list there too. I've heard good things. I've heard of the Die with Zero and the All In, and I'll check out the Masculine in Relationships. That's on my list. I'm writing it down. So
Awesome.
Speaking of Ed Milet, so he always says that you're best suited to help the past version of yourself. So who is someone your ideal, someone that you'd like to meet that you feel like as a teacher at heart, you could help a past version of yourself? Who's a candidate for your coaching program or your community, or just to be someone to meet you and be in business with you? Who is that person?
Yeah, the people I connect with the most are exactly, as you said, previous version of who I was. So high income W-2 salespeople that want to live life big and be top 1%ers in all areas of their lives. So that is my avatar for my coaching and for my passive investing opportunities. But of course, we help all shapes and sizes, but those are the people I tend to connect with the most.
Excellent. Okay. So how about any final thoughts you'd like to leave with our audience? Is there anything I should be asking you? I know you have a wealth of knowledge, and this is like probably a conversation that could go on for a while. I'm very intrigued by syndication just in general, because it's just something that's always been attracted to, is like the next level of beyond your average investor. Really, I mean, ironically, sophisticated that's the next level of sophistication when it comes to investing, buying bigger projects, going bigger with additional resources and returns. So is there anything, any final parting thoughts?
My suggestion to everybody is just start. Whatever it is that you're thinking about doing, just jump in and start. Buy a book, read a podcast, sign up for a mastermind, buy that first asset, make that first investment. Like, you cannot move a ship, or you can't turn a ship that's not moving. You can only turn moving ships. So get moving and adjust as necessary. If you're thinking about this space, get some dollars in the space, whether if you got $100,000, put 25,000 in 4 deals. Just like you will learn so much more by having some money in these deals than you will by just reading books or listening to podcasts. So that's my advice.
Excellent. Thank you so much. So how can we support you, and how can we connect with you and follow along with your journey and with Impact and stay in touch?
Yeah. So, the easiest way, I'm on LinkedIn all the time. So Randy Smith on LinkedIn. The website is impactequity.net. The podcast is The Gentle Art of Crushing It. We do a new episode every Thursday. And for folks that are interested about increasing their due diligence skills, either from a passive investor or from an active investor standpoint, I've got a free giveaway with a 100-point due diligence checklist on my website, impactequity.net.
Excellent. That's a very Merry Christmas gift to our audience, and I'm sure they'll be grateful. I'll check that out as well. And again, Randy, I can't thank you enough for taking the time to hop on here and chat with us, to introduce you to our audience. I've learned a lot. I hope you folks have as well at home. And thanks for tuning in to the Build Better Blueprint. We'll see you next time.